Kangaroo Studios, the AusBiz COB is the key stuff you need to know about the day in business and finance.
Hello and welcome to the COB on this Friday. I'm Andrew Gagan. Thanks for joining us as we unpack the day and the week. We take a look, we're finishing on a negative note. There we go. The COB 200 currently off around 0.5%. A little less pronounced on the ASX 200, nonetheless still off around 0.4% or so, but it is very much the material sector that's proving to be the largest drag on the broader market at the moment, as we've seen those that have done well in recent sessions are being sold off. That includes the biggest miners in BHP, Rio and Fortescue, certainly dragging there. Fortescue currently off around 3.5%. Well, let's get across the themes of the day and, well, banks out, bargains in. I guess particularly as we see the market at or near record highs, certainly investors looking for where those bargains may be. And iron ore retreat, the price has come off, and that's sort of reflected in what we have seen with the bigger miners, which have done very well given the iron ore prices being comfortably above $100 a tonne. And yes, will Jerome Powell succumb? You may well have seen that photo op of the Fed Bank chief with the commander-in-chief, i.e. the US president, at the Federal Reserve headquarters in Washington, which is undergoing renovations. And of course, Donald Trump using that as an excuse to perhaps elbow Jerome Powell out of the way, complaining that there are huge cost overruns at the bank. Jerome Powell, though, quick to point out that because Donald Trump was talking about 3 buildings that were being renovated at the moment, and Jerome Powell said, hang on, there's only 2. We've already done one. That's already accounted for. So it goes to that point of independence of the Federal Reserve. Will or won't he push Jerome Powell out of the way? Certainly the man himself saying and indicating that he's in no way prepared to move until his term expires, which is in May next year. All right, let's get across those sectors that are moving today, beginning with a look at energy, and broadly higher, and that's been driven by Woodside at the moment. In fact, no, we got mining first there. Well, I guess that's more appropriate because that's the big mover. In the negative today, as I mentioned, the bigger miners coming off. Fortescue dropping quite significantly. South 32 also down some 3%, whereas MinRes is bucking the trend. In fact, that in part is because we have seen further positivity among the lithium miners. Pilbara also a mover in the right direction. The banks, they are negative, mildly so, but Westpac is off the most there, and Macquarie fairly flat after, of course, falling around 5% yesterday after its AGM and a market update. Let's get to the top stories. KMD Brands, it has, well, in fact, that's not reflected there, but it was up around 4% after tapping Qantas executive Carla Webb-Sear to become the chief financial officer of the company. Newmont, it has bucked the trend of what we've seen in the gold sector today. It's up 3.7% after reporting a quarterly adjusted net income of $1.7 billion US, beating consensus by 23%. Steadfast has dipped on news that long-serving Chief Financial Officer Stephen Humphreys will retire at the end of August. And Isotana up 20%. It was up about 25% at one point after the software developer reported quarterly revenue of just shy of $500,000, up 13% on the third quarter, generated by deployments of existing orders and contract renewals. And Regal Partners jumping after the investment manager reported a 7% increase in funds under management for the June quarter, with the net inflows at around $600 million for the period. Well, let's get to that point of the week where we unpack it all and get some reasoning as to why markets are moving where they are. We welcome Shane Oliver again from AMP. Shane, welcome back. Good to catch up with you. Yeah. Let's start stateside, shall we? Because we've seen the Nasdaq and the S&P climb to yet more records. And investors clearly seeing, particularly the trade deals, from an optimistic point of view, despite the fact, take Japan for instance, it's still being hit with a 15% tariff.
That's right. I mean, I really don't see what's in it for these countries signing up on these trade deals. It all seems to be a big win for the US. and a loss for them, I would think it would be better for countries to just refuse the deal. But of course, once one or two countries do it, then it sort of opens a bit of a floodgates and it puts pressure on other countries to likewise do a deal. So at this point in time, Donald Trump seems to be winning. But if you average all the deals that have been put out so far, along with what he announced a couple of weeks ago would happen on 1st of August, then you are looking at a rise in average tariffs going into the US to around 20% from 15% currently. And as you point out, the average, that's from very low levels at the start of the year. I think the average was about 2 or 3%. So whichever way you cut it, we are going to see a big rise in tariffs going into the US. And of course, there's more sectoral tariffs to come. So this is something that can still cause a lot of consternation. I think to some degree, markets are celebrating, though. They're saying, well, the deals are being signed, so maybe it's not going to be as bad as we thought it would be. The numbers aren't as high in terms of the actual tariffs. China, I'd show Japan 15%, not 25%. Maybe Europe will come down from 30%, but still a lot of bulls in the end. Still some hefty tariffs going on there, which will affect economic activity. So consequently, you can see many markets, Europe accepted, and of course China around record highs, US and Australia around record highs. Japanese share market this week celebrated the trade deal with the US. I think the celebration there was more that the tariff on Japanese autos going into the US comes down from 25% to 15%, but it's still a hefty impost on Japan. And Chinese share market also not doing too badly in the great scheme of things, although if you look at a longer term chart, it's not so good.
Now, Shane, of course, someone's got to pay for these tariffs. We have heard from some US companies appear to be absorbing those costs. Is there going to be a point, though, where they're forced to push them over to the consumer? Also, obviously, anecdotally, we're hearing that consumer prices are already rising, of course, which may well be reflected in inflation data later on.
I think that point will arise. There has been various studies on this. Of course, the foreign exporter to the US could absorb the cost. There's not much sign of that when you look at US import prices. There's not much sign, for example, that China is absorbing the tariffs. I mean, there was some evidence that Japanese had reduced the cost of their autos going to Japan, but apart from that, foreigners not paying it, so therefore it's the importer paying it. They can take the hit on their margins for a while, and I suspect that's what's been happening, helped along by some of them front-loading their inventories ahead of the tariffs. Once that comes to an end, I think you'll see some flow through. And if you look at the business surveys that came out overnight, the so-called PMIs that were released, they showed, particularly for the US, higher input prices or still high input costs. They sort of bounced dramatically earlier this year and have stayed at that high level, and likewise output prices. So that's telling you that that pressure is there. And I suspect either we're going to see lower profits at some point, or alternatively, that gets passed on to consumers. And I suspect it's going to be a mix of both happening through time. So, and you look at the rest of the world, you're not seeing those pressures for obvious reasons, because the rest of the world is not imposing the tariffs. They're just getting their exports are getting hit by them, but they're not imposing the tariffs. So that's why you're not seeing tariff-driven inflationary pressure in Australia.
Well, let's turn to Australia, what we're seeing here, Shane. Now, of course, in the wake of the last RBA meeting, the perception was, and pretty much what was articulated by the governor, is that further rate cuts were simply being delayed. Yet, we have heard again from Michelle Bullock this week, perhaps raising the question that what the market has priced in for a almost certain rate cut next month is maybe not as certain as it should be, because she questions whether that trim in inflation is going to fall as much as forecast.
That's right. They have a forecast that when the numbers come out next Wednesday will show trim mean inflation at 2.6%. And the money market, I guess, is assuming that's going to happen. So you can see on that chart there that there's a 98% probability, almost 100% probability of a cut occurring in August. And then by the end of the year, we go out to December, 2.5 cuts. And then by early next year, by May next year, 3 cuts will have occurred. I reckon you might get those 3 cuts on a longer view, and I think we probably will, possibly more than that. But I don't think it's as high as 98% or 100% for the August meeting in 2 weeks' time, 2.5 weeks' time. I'd say it's closer to 80%. There is a risk there, as the Reserve Bank has pointed out, that those inflation numbers could come in on the higher side. So to get 2.6%, you've got to get in precise numbers, something like 0.59% on the quarter for the trim mean. If it's 0.6% or 0.7%, then obviously we jump up to maybe 2.7% or 2.8% on an annual basis. So there is a bit of risk there, and the risk seems to relate to some of the components that already came out in the monthly CPI that relate to dwelling costs not coming down as much as previously thought. So you might actually see a slight rise there, and also some of the other components in there, durable goods and so on. So there is a little bit of upside risk there, and several economists are sort of saying, you could get a number. We're forecasting 2.6%, but I've noticed that some out there are saying that it could be as high as 2.8%. Now, I kind of think that if that's the case, we'd probably still get a rate cut. If it prints at 2.8%, we'd probably still get a rate cut. But there's obviously a risk there, particularly if you get up to, say, 2.9%, which is where it was in the March quarter, that the Reserve Bank just decides to wait and see. That I think is a risk there. And I'd say it's about a 20% risk at present. But obviously those numbers will bounce around next week once we get to see that CPI release.
Now, Shane, in the wake of that non-cut at the last meeting, questions are raised about the communication from the RBA and the board. I see that you point perhaps to some of the reforms may have led to making that communication less effective.
I think it has, and this was always a concern when the review was published. I think back it was at May 2023. 2 years ago now, and there was concern expressed by some former Reserve Bank governors, particularly Ian Macfarlane, that it could make the Reserve Bank seem less accountable and could confuse communications, given that you've got these macro experts going on to the board, whereas previously the board wasn't quite set up that way. And you can make an argument maybe that's now starting to happen because we did see at the press conference 2 weeks back where Michelle Bullock was asked, well, why didn't you push back against market pricing for 100% or so chance for a rate cut, if you thought that was inappropriate? And you can make a similar observation. There's a lot less Reserve Bank speeches these days. They're just relying on the press conference. And Michelle Bullock's response was along the lines of, well, it's not our role to do that anymore. How can we say that given that it's a decision for the board? And she acknowledged that was a change from the prior situation, prior to the new board structure that started from February this year, where they would push back. They would be out there saying, well, they think that 100% is too much or whatever, or put in a speech and say we've got a different view, and then that would cause some adjustment. And now we're not getting that. I don't want to criticise the Reserve Bank's interest rate decision. It might just look like sour grapes on my part. I can say they got it wrong, all that sort of stuff. But I think there is an issue with the comms there that before there were more communications. And I do think ultimately it should be the Reserve Bank that should be accountable here. And it should be their role to push back against market expectations if they think the market is wide of the mark. And that's important, not so economists can just get the forecast right on the day or traders don't lose money. They don't matter in the great scheme of things. What matters is the general public. And the general public, I think, was of the view we were going to get a cut 2 weeks back, and we didn't get that, and that can lead to some confusion, and it can slow down the monetary policy transmission mechanism, make it less effective than it used to be. So I do worry that RBA communications have become a little bit less effective than they used to be, and that's an unfortunate outcome.
Well, let's see what happens after the next meeting. Shane, always great to catch up. Thanks for joining us on AMP.
Thanks, Andrew.
Let's now turn to our stock of the day, and to get across that, it was CSL, and we caught up with Junbei Liu and Ben Clark.
We do think that, but given where it is in terms of the how cheap it is, now heading into result with a double-digit earnings upgrade for next year, it looks very reasonable.
And if we're talking about CBA versus CSL, CSL at 1 July was probably trading at about a 30 to 40% discount in valuation to CBA. And it's probably growing, instead of 1%, it's probably going to be 10. So to me, it's just an easy, there's an obvious trade there.
So So let's quickly wrap it up then. The winners and losers in today's trade. Newmont certainly the top there after its production update. PECs are doing it well again today. Woodside also off the back of updating the market yesterday. On the negative side, checking in on those stocks that have not done well today. Champion Iron, in fact, those iron ore miners are dropping significantly today, along with the Goldies too, Genesis and Regis among them. Just catching up with what's on overnight. US earnings, among them we've got also US durable goods orders for June, and we also get the CommSec State of the States. This is next week, in fact Monday, the economic report card for the country. Consumer Price Index for the quarter. That's going to be all important. Perhaps will determine whether the RBA cuts at the next meeting. Also get building approvals and some RBA speak, as well as the Totality Home Value Index. All right, so let's see where we're likely to finish the day off around about 0.5% with half an hour of trade to go at this point. And thank you for watching and listening. And if you are watching live, the COB, or dare I say, we've just done the COB, the last call, that's coming up next.